All right, now let's do a question on reaching a financial goal. So 6 years from today, you need $10,000. You plan to deposit $1,500 annually, with the first payment to be made a year from today in an account that pays an 8% effective annual rate. Your last deposit, which will occur at the end of year 6, will be for less than $1,500 if less is needed to reach the $10,000. How large will your last payment be? Now, in this particular case, I prefer to make timelines because it lends a lot of clarity to the situation. So we've got 6 years. Let's add one more right there. Okay. All right, now in these 6 years, we are going to deposit $1,500 every single year. Let's go ahead and turn that a little bit. So $1,500 every single year for 6 years, with the idea that we will need something less than $1,500 here at the end, and that's what we want to calculate. Our final goal essentially is to reach $10,000. This is the amount that we want in the account at the end of our 6th year. In order to solve for this, we can see that first we need to determine how much money will be in the account based on the compounding that takes place on the amounts that have already been placed. So that means that first and foremost, we are going to calculate what this amount is going to look like at the end of 5 years. So let's see what we'll have at the end of 5 years. Because we're talking about a point ahead in time, we'll be calculating the future value in both instances. So the formula for a future value of an ordinary annuity is equal to PMT times 1 plus I to the power of n, because we're compounding, that exponent there is positive, minus 1 divided by I. The PMT in this particular case is $1,500 because this is the amount of money that you're going to be depositing annually. So 1,500 and 1 plus I is based on the effective annual rate. That's 8% effective annual rate, so 1.08. Because we are looking at it at the end of the 5th year, so we're going to use n as 5 minus 1 divided by 0.08. So when we plug that into a calculator, we are going to get a future value of 8,799.9. This is the amount of money that's going to be in our account at the end of the 5th year based on this cash flow. Now, remember, to get this amount of money into, okay, let's go ahead and write that over here. So to get this money into the 6th year, that means $8,799.9 is going to have 1 more year of interest added into it. And so here we're going to use our simple formula for lump sum. So future value is going to be equal to present value times 1 plus I to the power of n, where the present value is equal to $8,799.9. 1 plus I, again, we're talking about the same effective annual rate, so 1.08. And because it's being compounded for only 1 year, we raise it to the power of 1. Now, once we add this compounding, we will get, and we put this into our calculator, we get 9,503.89. That means that at the end of the 6th year, based on your previous cash flow, you're going to have $9,503. So when you need to determine how much you need to deposit at the end of the 6th year to reach your goal of $10,000, the final payment is going to be equal to your goal, that's $10,000, minus what you've already accumulated of 9,503.89. And the difference between these two is 496.11. And so that is the amount of money that you're going to deposit as your last payment. And don't forget to like and subscribe. Drop a comment below if you have any further questions.